Hello, everyone. Good morning, good evening, good afternoon. Hello, everyone. Good morning, good afternoon, good evening. Welcome to this webinar, Dancing to Their Tune, Credit Rating Agencies, Sovereign Risk and Financing Conditions in the Global South. Sean todos bienvenidos al webinar Bailando al ritmo de las agencias de calificación crediticia, riesgo soberano y condiciones de financiamiento en el sur global. Tenemos interpretación simultánea en 4 idiomas: inglés, español, francés y árabe. Por favor, identifiquen en la parte inferior de sus pantallas, en el icono correspondiente, el idioma de su preferencia. Aclarar que el idioma árabe está en la opción de alemán por alguna cuestión técnica del Zoom. Just to clarify that we have interpretation in 4 languages: English, Spanish, French, and Arabic. In the case of Arabic, please find it in the German option, as for some technical reasons we couldn't identify the Arabic option in Zoom. So thank you so much. Mi nombre es Patricia Miranda y tengo el placer de ser la moderadora de este webinar el día de hoy. Este es un webinar coorganizado por la Red Latinoamericana por Justicia Económica, Social y Climática LatinDat y por Third World Network, TWN. Ambas organizaciones nos hemos sentido motivadas en realizar esta iniciativa por varias razones. Nos encontramos en un contexto de crisis, con un acceso a financiamiento caro para los países del sur global, con grandes brechas de espacio fiscal para lograr la Agenda 2030 y la Agenda climática, así como otras necesidades urgentes que tienen nuestros países. Esta situación ahonda las vulnerabilidades de deuda que se caracterizan por elevados pagos en el servicio de la deuda respecto a nuestros presupuestos públicos, respecto a los ingresos tributarios. Actualmente, 3.300 millones de personas viven en países donde se pagan más intereses por la deuda que lo que se invierte en educación y salud. En este contexto, las agencias de calificación crediticia tienen un rol clave en el acceso al financiamiento. Sus decisiones no solo reflejan los riesgos sobre la capacidad de pago de deuda de un país, sino que también influyen en los costos y condiciones de endeudamiento, en los tipos de cambio y la estabilidad económica, con implicaciones directas sobre la sostenibilidad de la deuda. Credit rating agencies, CRAs as we call it, have an influence over sovereign borrowing costs. The nature of procyclical downgrades that penalize developing countries for exogenous shocks, as we have seen in the past, as well as the central role of the cost of capital in global development financing and long-term investment. These concerns are not new. The United Nations started intergovernmental dialogues on CRAs after the global financial crisis of 2008, recognizing that credit ratings are a critical factor in the global sovereign debt architecture. In 2012, a UN General Assembly resolution to work on CRAs was passed, recognizing the significant role they played in sovereign debt dynamics, and led to a special thematic debate in 2013. After these, more concerns raised, as, for instance, the market concentration of CRAs, the need for improvements in their transparency and impartiality, encouraging alternative risk assessment approaches. So where we are now, in July 2025, last year, the fourth Financing for Development Conference, which was held in Sevilla, led to an outcome document that called for more accurate, objective, and long-term oriented credit ratings. The Compromiso de Sevilla, which is the outcome document of this conference, decides to establish a recurring special high-level meeting on credit ratings within the UN's Economic and Social Council, ECOSOC, and urges sovereign borrowers to consider national regulatory frameworks to reduce over-reliance on credit ratings, increase transparency regarding the issuing of sovereign debt ratings, improve the quality of the rating process, and make CRAs more accountable for their actions, as well as reduce the conflicts of interest and encourage a greater number of actors to operate in the credit rating market. A special meeting on CRAs will take place next Monday, next week, at the UN. At Latindat and Third World Network, our objective is to contribute to these discussions with proposals, with analysis on CRAs through this webinar. And here we will present a joint briefing from both organizations to analyze the role of credit rating agencies in the international financial architecture and chart alternative institutional and methodological approaches towards sovereign risk assessments that serve development objectives through greater accountability, impartiality, transparency, and, as we say, fairness. This briefing, which link you might see in the chat in both websites of our organizations, reflects a summary of the contents of an in-depth joint report that will be launched by mid-April. Without further ado, I would like to introduce our panel. All of them have been part of this report and have contributed with contents to this briefing. I would like to welcome Dr. Patrick Ndezana Olomo. He is the head of the Economic Policy and Sustainable Development Department at the African Union Commission. I would like to welcome Dr. Susan Schroeder. She is from the Department of Political Economy at the University of Sydney, Australia. And also would like to welcome my colleagues, Dr. Bhumika Mushala from the Third World Network, Jorge Luna from Latindat, and Maria Cid from Third World Network. We will begin to share this briefing that I mentioned by presenting the conclusions. We're going to start with the last part, which is really an important contribution from this report. The establishment of an independent African credit rating agency led by the African Union and supported by the outcome of the fourth FFD conference. This is one of the conclusions. And the other one is to discuss on the already existing proposals to create a multilateral credit rating agency. So I would like to invite our first panelist, Dr. Patrick Olomo from the African Union Commission, to share with us a strategic vision on institutional framework for the African Credit Rating Agency. Patrick, please, the floor is yours.
Thank you. Thank you very much, Patricia, and thanks for inviting the African Union to this very important discussion today. I think we stand at a very critical moment in our historical context. And in that perspective, it is important to remind that establishing the African Credit Rating Agency is a matter of development, is a matter of survival for the African Union as we speak today. When we look at the international context and the global dynamics on the flow of investment globally, we can see that Africa has been deprived of investment since quite a long time, and that is due to the fact that there is a risk appreciation on the continent that is not aligned with the fundamentals of our economies. This speaks to the nearly 70 billion US dollars that we are losing approximately per year due to poor credit rating. And when we look at the sustainable development financing gap of the continent, which is estimated at approximately 472 billion US dollars per year, you can see that this represents a significant amount of resources that can be clearly invested in productive transformation and in critical sectors such as agriculture, services, health, and education. This, we believe that should be reversed, and that is why the African Union heads of state and government have adopted a decision aiming to establish the African Credit Rating Agency. The Credit Rating Agency will be a private sector-led and owned institution that will have the opportunity to work on evaluating the risk on the continent and to giving a balanced perspective of what credit can be, credit rating can be on the continent. It is not opposed to the already existing institutions that are doing that work, but it is aiming to provide another perspective in terms of how credit can be appreciated on the continent and the perception that should be the real perception of risk on the continent in Africa. That is why we have started working with our ministerial meeting and central bank. The decision of heads of state is fully implemented with a view to addressing the perception that we have on the continent in terms of the opportunities, but also the risk that are, really available. When you look at the geopolitical context today, you can see that the geopolitical context is marked by uncertainties. These uncertainties are not only about Africa, they are about the globe as a general. And in that perspective, it is important that when risks are evaluated, that they really express what we have on the ground and how we can ensure that we tackle those risks in a much more constructive and inclusive way. That will be the work of the African Credit Rating Agency, which will not be a task that will aim at easing the burden, or proposing, African-friendly ratings, but it will be a real evaluation that will be based on international standards that will be defined to make sure that the methodology that we apply here is not a methodology that is imposed as the one that we have in the international credit rating agencies existing today. If you look at the FFD4 outcome document, you will see that in the outcome document, it is clearly stipulated that there is need for an international discussion on the methodology of credit ratings worldwide. It is certainly not because only of Africa that this decision was taken at that high level to ensure that there is a review of the methodology of credit ratings, globally. For us on the African continent, as I said earlier, it is a matter of developmental survival because we can only mobilize resources if we have credit ratings that are aligned with the real perspectives of our continent. And that is why we are calling for that institution to be set up at the African Union level. And we do believe that it will ease the way business is really done on the continent, providing clear information about the opportunities, but also the challenges that are available, and giving clear guidelines in terms of how we can proceed forward. That is the perspective we are aiming to build with the African Credit Rating Agency. And we do absolutely believe that the Global South can play a critical role, working with the African Union to ensure that we start at global level to have that conversation on the Global South, because investments are absolutely needed in our regions to unlock the potential of our economies. We can't do anything. We cannot invest sustainably if we have ratings that are not aligned with the real potential and perspectives of our economies. It will be a missed opportunity to miss the train of taking advantage of the outcome of the FFD4, which was also reinforced by the Common African Position on Debt, because you can see that there is a link between credit ratings and debt in all our countries and regions. On African context, as I highlighted earlier, we are losing an approximate amount of 70 billion US dollars due to adverse credit ratings, which is also part of the explanation that is increasing our debt burden as we proceed in the international setting. So it is for us a constructive engagement that we have started. It is a call for fairness, a call for making sure that finance effectively work for development, and credit ratings are, in that perspective, one of the critical milestone that we need to achieve moving forward. In terms of practicalities, the African Union is aiming to establish the African Credit Rating Agency by the end of 2026. We have a clear timeline and we have milestone that we are achieving to make sure that we implement that decision fully and to absolutely be able to support our countries moving forward. With this, Patricia, I would like to stop here. If I'm allowed to speak later, I will certainly provide more details about what we do and how we do and how the international community, more importantly, the Global South, can work together to ensure that ratings are aligned with the real perspectives of countries, and that also ratings are developmental friendly to address the challenges that the Global South is facing. Thank you, and back to you.
Thank you so much, Patrick, for providing all the needs with a different perspective to reflect the real perception of risk in Africa. And well, allow me to say that Africa has been leading positive initiatives, not only for Africa, but for the Global South, as you mentioned, not only on CRAs, but also on debt and taxation in the past. So thanks for that, Patrick, and we will be looking forward to continue this discussion later on. So I would like to following with these conclusions, I would like to invite now to Susan Schroeder from the University of Sydney, Australia, because it's important to see what other proposals are on the table. And there are other regions that have proposed an alternative credit rating agency. For instance, the UN Economic Commission for Latin America, ECLAC, presented a report with a proposal which was led by our next panelist, Susan Schroeder. Susan, what is the proposal about on a multilateral credit rating agency? Thanks so much. The floor is yours.
Okay, well, thank you very much for allowing me to contribute to your webinar. I speak to you from Sydney, Australia. It's about just after 12 midnight, so I'm going to push through as best I can with the time frame. I do have a couple of PowerPoints that I can share with you. Translators might appreciate it. I can also send it to you to help them when they complete their transcripts. So I'll speak to that. As is well known, the credit rating industry has had problems over the years. And there are some basic issues, such as the issuer pays model, which generates conflict of interest in generating the ratings. They tend to be overly optimistic under that structure. We do have the structure of the industry itself is controlled basically by three large firms, and they're centered in the United States, in New York. Fitch does have a split headquarters in London, so there is that issue. It's my understanding that someone is going to speak to those. Patricia will speak to those, or it will be spoken to these issues in more depth. So I would like to sort of press on with some other things that we noted. So conflict of interest, post-cyclical changes and triggers, the issue of PACE method, and the regulation and oversight of the processes and behavior are just a few things that we've seen with this industry. One issue that emerged strongly during the COVID pandemic was possible bias in the ratings methods. And what caused people to be alerted to this issue was the EMDE sovereigns in Latin America and the Caribbean and in Africa experienced frequent downgrades in their sovereign ratings, while developed or advanced country sovereigns did not. And why is this? The EMDE sovereigns spent less to support their economies as a percentage of GDP. They spent less as a percentage of GDP than the advanced economies did, yet they were downgraded more. So there are two basic opinions on the what's happening. The first is that EMDE sovereigns are inherently riskier than sovereigns of developed countries. And so from that perspective, the implication is that the credit rating agencies' methods are fine. They're working well, they're capturing what should be captured. The other opinion is that there could be bias in the method or with how methods are constructed by the rating staff. Yeah, and this is something which I spoke to in my work that was released in 2023. The issue of bias and other issues related to the rating industry suggest a need for an independent space, an international space, with support staff to engage stakeholders and forge a better understanding. And that space could be a multilateral credit rating agency located in the global south. The two objectives of the multilateral credit rating agencies are to improve credit risk assessments, and to advance the UN's SDGs. All right, so there were two objectives that I had to meet in my writing on it. The functions of the multilateral credit rating agency, and these are not inclusive, but these are the main ones that I'm going to speak to, are due diligence. All right, due diligence currently is performed within the rating agencies, and there is no independent observer about the evaluation of the robustness of the methodologies. So that would improve transparency and accuracy in the credit risk assessment methods. And then also to develop forward-looking approaches to credit risk assessment. And that would be putting credit risk assessment on the longer-term horizon than what is currently done, And then evaluate the satisfaction of society's basic needs. And we do that through the UN SDGs. Good growth, as we know, does not guarantee improvements in SDGs. All right, so if you look at the dashboards for SDGs and you look at how countries are performing, even the best countries, they have a range of issues which need to be addressed. Okay, no one country is perfect, and so so good growth. That's emphasized in credit risk assessment, but doesn't mean that the SDGs are performing well. And then also assist the sovereigns to target expenditures more effectively. That would also help with the evaluation of satisfaction of society's basic needs and facilitate stakeholder engagement. Right. A couple of things that the MCRA could also do is evaluate potential feedback effects and pro-cyclical changes that involve the ratings agencies. So this implies, and it's not currently done, but I think it's important to recognize the importance of industrial configuration within credit risk assessment. Capital-intensive industries, for instance, are pro-cyclical, and EMDEs rely on certain capital-intensive industries for development. These include mining and manufacturing. So recognition also that not all industries are productive, of new goods and services as evidence of new wealth, right? So this is something which is not currently performed by the credit rating agencies. they look at industries which may be, what's the word I'm looking for, which may be influencing the development of EMDEs, right? They're looking for specific industries for which the EMDEs may be over-relying for trade and for location of revenue to help support debt service. But if you look at the range of industries and the feedback effects that you have, and that is likely to be linked to the pro-cyclical behavior of the risk assessments. All right, so examples of industries which are not productive of new wealth in terms of goods and services, the fire activities, yeah, and this is finance, insurance, and real estate. All right, these activities tend to involve transfer of titles, transfer of ownership, and not so much the generation of new goods and services. So the implications for this is that the GDP, its growth, its trajectory may be slightly different than what we see when the fire activities are included. And so that means that debt sustainability has to be conducted not just with the tools that are currently in use, but also be supplemented with a systematic treatment of industrial configuration. Also related to this point is the lack of recognition of the credit rating agencies of SMEs, small and medium-sized enterprises, and the informal sector. Both of these could act as shock absorbers in the event of instability, and they're not accounted for well at all in the methods of the credit rating agencies. So risks related to the environment and social context enter peripherally in the methodology of the credit rating agencies. They enter as refinements of methods, as qualitative adjustments. So it's a bow to the importance of these, but they're not well integrated. And this leads to the possibility of developing a complementary rating scheme with a longer-term timeline, which will likely embed credit risk assessment within the longer-term dynamics associated with the SDGs, right? So let's break down that thought. Stages of development and trends associated with long-term dynamics of development can help unlock the mystery of whether bias is present in the ratings methods. All right, so the ratings methods currently have a 3 to 5 year horizon. All right, so some of the data that they use do have a rather long-term trend focus, but the outlooks themselves, the credit risk assessment is going to be on a 3 to 5 year time horizon, and that's to appeal to financial investors. All right, so long-term dynamics associated with climate change and inequality are slow to change, which means that when you look at that long-term horizon, the 3 to 5 year horizon, you can treat those long-term dynamics as essentially constant, right? So with long-term dynamics, they're essentially constant when you have that 3 to 5 year outlook, right? Because they are so slowly changing. But if you have credit risk assessment embedded with SDGs, which will have a longer term time horizon, you can recognize those dynamics more explicitly and account for their influence, on fiscal positions and debt sustainability. Right, and that's my sort of quick overview of the MCRA. The statement that I provided to Patricia Bhumika is a bit more in depth, as is the paper that I wrote and that's been published, within ECLAC's publication on innovative financing instruments that came out 2-3 years ago. So thank you for letting me to comment, with your webinar, and hopefully I've been helpful, and happy to take questions and feedback.
Thank you so much,
Yeah.
Susan.
Yeah.
Thank you. Thank you so much, Susan. First of all, for staying up late at night for you. We truly appreciate it. And also thanks for bringing this a comprehensive proposal of the features, benefits, and advantage of what it could be a multilateral credit rating agency, linking with SDGs achievement, but also on impacts on development. Well, now I would like to move on to our other panelists. Why these are key and why this initiative of having an independent or having an alternative credit rating agency could be a game changer in the current context. And I would like to invite our next panelist, Bhumika Mushala from the Third World Network, to share with us an analytical overview and the main critiques we find related to the current context and the current actions, assessments, results, and impacts from credit rating agencies. Bhumika, the floor is yours.
Thank you, Patricia, and welcome everyone. It's great to see all of you here for this timely event on rating agencies. Just to begin with, I'd like to say that we are grateful for both Patrick and Susan's participation and contribution in our report. As Patricia mentioned, our report will be forthcoming in April in final draft, although we have a short version already posted today. I also want to thank our researchers, Maria Said and Jorge Luna, for the excellent case studies and empirical data and assessment that they have put together. Patricia and I have been collaborating on rating agencies since the fourth Financing for Development negotiations. And in Sevilla, we also, had organized an event to uplift the critical role of rating agencies in the nexus of sovereign debt, climate vulnerability, and pro-cyclical financial architecture at large. And so this is fantastic to now continue on our collaboration several months later. So let me begin with really laying out why we are focusing on CRAs to give an assessment of the literature review. There is quite a significant literature review on rating agencies. And some of the critiques that we want to focus on that actually lead directly to what Patrick and Susan have proposed. So rating agencies ostensibly act as a bridge between lenders and borrowers by reducing the information asymmetry, as stated, through the provision of expert information on issuers and borrowers of bonds and other debt instruments, as well as fixed income securities. Its primary concern is the creditworthiness of the borrower nation or the sovereign risk of debt default. The risk assessment that sovereign ratings issue is essentially a judgment. And increasingly, it's clear that it's a subjective judgment that influences investor decisions on where to lend money to. It determines the ease or difficulty of sovereign access to external finance, shapes the price of debt instruments that countries repay, and directs credit flows at large. The empirical literature on rating agencies' influence over investor behavior in particular illustrates that ratings affect both credit flows and yields levels disproportionately for the global south, in that yields move in the direction of CRA opinions and assessment to a degree that is statistically significant. So really, this is what underpins a lot of the critiques, this disproportionate influence that is statistically significant. So the context for the global south, we all know that there is a multidimensional and vast range of exogenous shocks, from economic and financial crises that are recurrent due to the pro-cyclical and the deregulated nature of capital flows in our financial architecture, to increasing climate disasters and shocks, as well as pandemic and health shocks, chronic debt distress and episodes of default and restructurings, And as of the last many years, war and conflict in multi-spatial areas of the world. So the current moment in particular, we are concerned with the oil price shocks for import-dependent countries as key channels of risk rating downgrades. But essentially the point is that all of these exogenous shocks are channels, transmission channels of risk rating downgrades, or the warning of a downgrade that result in a material effect, the higher terms of borrowing. Indeed, sovereign debt levels in particular, as we know, have reached a new historical record in 2024 to 2025, double that of 2010 after the global financial crisis. Now, a critical component of the sovereign debt distress is the surge in interest payments for developing countries. So on average, developing countries face 3 to 5 times higher borrowing costs than rich economies, even when they have faster growth, lower debt, and stronger macroeconomic fundamentals. Especially sort of the sound finance, macroprudential finance context of low deficits, low inflations, and sustainable debt to GDP ratios. So in this context, approximately 74.6% of developed countries have investment grade credit rating, relative to 9.2% of developing countries. It is this, a gaping asymmetry that we are looking at. And within the 9.2% of developing countries, it is disaggregated to 18.5% of upper middle income countries that have investment grade rating, 4% of lower middle income countries, 0% of low income countries. Consequently, we have a situation where assessment of the borrowing costs of 16 African countries in 2023, done by a group of researchers, estimated that the cost to African countries of even a one-level misalignment of credit ratings.
Omika, I'm sorry, the interpreters kindly request if you could slow down.
Yes,
Thank
of
you.
course, yes. Very sorry to the interpreters. I will just repeat that just the cost of the one level misalignment of credit ratings amounts to approximately 74 billion in lost investment opportunities, as well as increased interest payments to African nations. Meanwhile, there's approximately 30 trillion on average per year of global savings that flow overwhelmingly to the economies already rich in monetary, material, infrastructure, and investment capital. So in this context, this is where we turn to key critiques of rating agencies. And I hope you can see it outlined in the slide. So when we want to start with the overview of the critiques, the first point is that there is a de facto monopoly structure. Right? We heard from Susan, and we all know that there's a big three, Moody's, Standard and Poor, and Fitch ratings, all headquartered in the US, primarily, that control more than 94% of outstanding credit ratings. This is, the key block to a plurality of agency formations. It also then consolidates the structural power to exert quasi-regulatory power in global capital markets, despite being private firms operating within highly concentrated and non-development oriented incentive structures. So this really then leads to the fact that this access to external finance is mediated through private assessments that amplify pro-cyclicality, favor short-term fiscal adjustment, and systematically penalize exogenous shocks, no matter what the source, whether it's climate vulnerability that is of no fault of the nation or imported inflation shocks due to world events. The conflict of interest model was mentioned by Susan, and just to come back to that, the conflict of interest is generated by the issuer pays model. This is a structure where rating agencies deliver judgments to the very financial clients who pay them for assessments. This transactional relation means that rating agencies are incentivized to promote the very policies and priorities that maximize client profits and market share. This conflict of interest dilemma has raised, consistent questions on the objectivity, accountability, transparency, fairness, and incentive power in the practice of rating agencies by even the most basic standards. On the bias in methodology, we focus on the fact that rating assessments are skewed by the single criterion of GDP, not actual risk. Empirical analysis shows that GDP per capita, not solvency indicators, are the strongest predictor of ratings issued, and that too on short-term trajectories of 3 to 5 years. In contrast, a medium to long-term trajectory, as was highlighted in the MCRA, Multilateral Credit Rating Agency proposal, would consist of up to 30 years with a minimum of 10 years. This time frame is also a key factor that penalizes low-income countries regardless of investment quality or growth potential, both of which require a medium to long-term horizon. Countries with high inflation as well have lower ratings, unsurprisingly, and this is problematic because we are in a global context of chronically imported inflation through exogenous shocks, particularly in the global south, whether it be through commodity prices or international monetary tightening led by the US Federal Reserve. So meanwhile, importantly, the debt to GDP ratio, the 60% of sovereign debt to GDP ratio, has not been found to be statistically significant. And this reflects the fact that many high-income countries are accorded AAA ratings despite debt to GDP ratios well above 100%. So I'm getting to my conclusion and want to highlight also that one of the key critiques is that as financialization has expanded into dominance across the global economy since the late 70s and early 80s, fiscal consolidation, or in other words, fiscal austerity, is viewed by rating agencies as credit positive. And this has generated a dynamic that has been called by CRA scholars as the downgrade austerity vicious circle. We see this clearly again and again. During the COVID pandemic, rating agencies downgraded numerous sovereigns through placement on a negative watch. The message transmitted was that spending what is needed on the pandemic will invite rating downgrades. This is a quote directly from the Financial Times at the height of the pandemic in June 2020. Thereby, in order to signal creditworthiness, fiscal policy is typically tightened as sovereigns adopt policies that address the short-term concerns of portfolio investors, even when they are in conflict with long-term development needs. So, last but not least, and this is a cursory overview of the critiques, by no means exhaustive. There are many other dimensions from rating committees to the role of institutional investors. But what our report will also focus on is a climate vulnerability index, the CVI, that the rating agencies have developed, through which many nations have been downgraded immediately after a climate disaster, exactly when concessional finance is needed urgently. And also the vulnerability to climate shocks alone, regardless of a disaster, is a risk criterion in assessments. So here I conclude by reminding the audience that recurrent financial and economic crises also demonstrate the damage wrought by CRAs. Let's not forget, going back to the Asian financial crisis of 97 to 98, CRAs were pointed out to have really exacerbated the crisis for Asian nations far more than the macroeconomic indicators warranted. In the global financial crisis of 2007, mortgage-backed securities were consistently rated favorably, playing a part in the most spectacular loss on structured assets in modern economic history. So there's been all these attempts by US authorities, the European Parliament, to pursue billion-dollar lawsuits against the big three, to create regulatory oversight. The European Parliament created something called the European Securities and Market Authority, Congress created the Dodd-Frank Wall Street Reform and Consumer Protection Act after the global financial crisis, and yet the big three endure. So more than a decade later, the big three are just as influential and profitable as ever, and once more the public braces itself of sovereign debt crises triggered by downgrades. So with this, we want to turn to our next two panelists who will illuminate country case studies of the impacts across Africa, Latin America, and Asia.
Thank you so much, Bhumika. Finally, as Bhumika mentioned, we have examined the empirical impacts of CRA assessments through national case studies from three southern continents. And I would like to invite Jorge Luna to provide overview of our key findings for the Latin American country cases. Jorge, please, the floor is yours.
Thank you, Patricia, and thank you everyone for joining us. I'm going to share my presentation. Okay. Okay, let's start. First, I want to take a few times just to explaining the methodology that we use in the document, not in this brief that we sent you yesterday or even now, but in the complete document that we will launch soon. First, the research design is a comparative narrative design. The focus is on episode where rating actions are part of the wider macroeconomic stress dynamics rather than isolated events. The objective, as Bhumika mentioned, is to trace how driver event is translated into a CRA signal and how markets reacts, and how the episode affects borrowing costs, refinancing capacity, and external debt service. We have boundaries, and essentially those boundaries is that this analysis is not an econometric analysis in the sense that we are not looking for causality or correlationship. Although we construct causal chains that we use in the case of a study, and the first step of this causal chain is the structural context, where we use variables as GDP, inflation, fiscal balance, external balance, research, the debt profile, and the exchange rate regime, which is important specifically in the case of Latin America, because in the cases that I will present in the next section, we have 4 different countries with 4 different exchange rate regimes. So this is the first step. Here's essentially the preconditions, the precondition variables before the event driver. Then we define the driver event in the sense that there is a trigger event that causes that follows the consequence causal change, and in this part we use variables as debt restructuring. We classify this driver event into 3 main groups. The first group is debt restructuring. The second one is the climate shock event driver, and the last one is the public expenditure adjustment driver. The assigned driver captures the core mechanism underlying both downgrade narrative and the financing implications. Then we have the CRA response, and in this part, we are essentially trying to find methodology consistency versus bias. And in this part, the thing that we did is use the S&P framework as a benchmark that includes 5 pillars: the institutional pillar, economic pillar, external pillar, fiscal, and monetary pillar. In order to ask which pillars are activated in each episode and whether the response looks symmetric or pro-cyclical. Then the most important part of the analysis is to understand the short-term reaction and the middle-term reaction. The first part, the market reaction, we use basically high-frequency data, almost with daily observations. where the data permits, we use spreads, bond yields, interbank rate, exchange rate, default probabilities, and finally the transmission channels that we're trying to seek how the middle term and the long term is affected. And of course, the impact in the borrowing cost, the market access, refinancing capacity, and finally the debt service over time. So after saying that, I will proceed with the first case of a study, which is Argentina. Argentina, the driver classification is the debt restructuring, starting with a political shock. The trigger event was the PASO primaries, who changed the expectation about the policy continuity and the repayment strategy. Then the later reprofiling announcement intensified this episode. The CRA reaction was the agency's first downgrading on higher default risks, then treating the maturity extension as a selective default event. The immediately market reaction was the spreads of 1 year default probability rose sharply, and the exchange rate did not move initially because the central bank spends more than 1 billion in reserves to support the national currency, in this case, the peso. The transmission channel is quite frequently in the global south. Is the political show triggers a sharp rise in sovereign spreads, then is transmitted to exchange rate. Then, if the monetary authority reacts, is reflected in a loss of international reserves. And in the case of Argentina, this process eventually led to introduction or reintroduction of foreign exchange controls. And well, from the perspective of monetary hierarchy, that is a concept that we use in the complete document as a part of our methodology. These dynamics reflect a structural vulnerability associated with the subordinate position of domestic currency with the international monetary system that is related with a monetary hierarchy. The key implication in this case of Argentina is that this case shows the clearest amplification case. The downgrade did not start the crisis for sure, but they convert a rollover shock into a formal debt narrative. The next case is Ecuador, which is classified in the same driver, debt restructuring. In this case, the trigger was, first of all, the pandemic, then the collapsing of oil prices, and the loss of market access turned liquidity stress into a restructuring episode. Just remember that Ecuador is a dollarized economy. So when we talk about when I talk about the monetary regime at the beginning of the presentation, this is why. Then the CRA reaction is after consent solicitation and the grace period strategy were read as an imminent default by the CRAs. This is trade exchange greater than ordinary temporary relief. And in this case, as I mentioned, Ecuador is a little bit different because it's a dollarized economy. So dollarization removes the exchange rate channel, is probably the most traditional channel that we track when we are doing analysis like this. And this episodial lacks in that sense, also Ecuador lacks on consistent domestic yield curve. So we analyze Ecuador through sequences and financing restrictions. The transition mechanism in this case is Ecuador removes the possibility of absorbing shocks through exchange rate because it's a dollarized economy. And without that buffer, the need of dollar liquidity becomes far more visible. So the limit policy instrument available in a dollarized economy combined with restricted access to financing tend to deepen financial and external tensions with capital flow reverse. In this case, the transmission channels operates through sovereign premium, the bond pricing, and the formal classification of credit event. The key implication in the case of Ecuador is probably the clearest example of how dollarized regime the CRA driver and stress in transmit through external financing conditions. The case of Colombia is different because, well, the trigger, even the classification, the driver classification is different. Public expanded adjustment driver. The trigger was the activation of the escape clauses and the suspension of the fiscal rule undermined the country's main fiscal anchor. And the CRR reaction was the agencies, all of them, well, in this case, S&P and Moody's, activate both fiscal and institutional pillars, interpreting weakening policy predictability and sovereign risk deterioration. The market reaction was immediately moved in the spreads. The exchange rate of 10 years yields was relatively modest, and after a few weeks was partially reversed with something that we call the event window using the variables of high frequency. Talking about the transmission channels, Colombia transmission channel is mainly disciplinary rather than immediately. The drag rate validates a narrative of fiscal and institutional weakening, increased volatility, and help narrow policy space, even without a lasting market price shock. The main implication is that transition channel was not a sustained market shock, but a mechanism of validation and discipline through which CRA's action reinforced a narrative of fiscal and institutional weakening. Finally, the last case of a study is Belize. Belize also is classified in the debt restructuring driver. And the trigger was, in the first instance, the pandemic, which stressed they pushed the super bond. The super bond was on a structure that Belize had in that moment. The center of the sovereign rate the story and led a selective default classification. The CRA reaction was that ungraded only after blue bond transition and debt exchange were complete. The market channel, in this case, in the case of Belize, they use another monetary mechanism, which is the hard peg. So the adjustment, not just through the depreciation, because that hard peg of the currency, and the threshold of foreign currency liquidity, market access, and refinancing risk. The transmission channel was the exit from stress deepen of credit enhancement, official banking, and political risk insurance. Financing conditions improved because risk was institutionally repacked, not simply because fundamental recovery endogenously. The key implication is that improvement in financial conditions depends heavily on external support and risk mitigation, not only on domestic adjustment. Then the cross case findings, just to summarize, and probably the most important part in this section, is although the rating action shows some signs of methodological consistency, the quantitative variables suggest a scope of bias influence judgment. As Bhumika mentioned in her presentation, sometimes CRS just act driven by bias. So in this case, although we can find some methodological consistency, in most of the cases, they are influenced by bias, and there are many kinds of bias. The complete analysis will be presented in the complete document. And then I'm gonna give the floor to my colleague, Maria. Thank you, everyone. Thank you, Patricia.
Thank you, Jorge and Maria. Sid from the Third World Network, please, I invite you to present the country cases from Asia and Africa.
Thank you so much, Jorge, for detailed analysis of the methodology that we constructed together. And thank you everyone to be here. I will take the lead and I will continue with the case study analysis. I hope you could see the slides. And with the case of Indonesia, which seemed to be an intriguing case when it comes to how the public spending adjustment was one of the main drivers of response of the credit rating agency. In case of Indonesia, it was mainly Moody's and Fitch. And the biases of the justification was in response to the public spending initiatives which were taken by the Indonesian government with regards to free nutritious meal programs, energy subsidies, and funding for village cooperatives. And then the influence was mainly coming from the fact of the market fears and subjective policy predictability that indicated some bias beyond hard data. Because in case of Indonesia, what is something important to consider is that the downgrading had been very recent. So it was done in February 2026. However, the warnings had been continued since 2025, January 2025, when the government announced these public expenditures. In terms of the short-term response, analytically and methodologically, as Jorge explained, yeah. Thank you so much. So in terms of the short-term response, we could see that the market reaction was actually notably limited. And it could be said that the reassessment could be a blend of methodologically grounded evaluation when it came to like giving warning signals regarding the fiscal sustainability. But at the same time, the macro fundamentals were quite strong in the sense that the sovereign yields were only marginally affected. The US sovereign spread only increased marginally, and the rupiah moved really slightly. So the exchange rate, there was a very limited or minimal currency pressure that could be seen in terms of the warnings. When it comes to the transmission mechanism, there was a minimal rating improvement even after 2023. I'm sorry, we have to go back to the case of Indonesia. Yeah. So the transmission mechanism could be seen, as Jorge outlined, to the risk premium, the foreign exchange dynamics, and the investor portfolio assessment. And there was a muted immediate impact. When it comes to seeing how the long-term effect could be analyzed, this is something still in process because the downgrade is super recent. And what we could see in terms of the reactions is mostly in terms of the warnings that were presented by the credit ratings, and especially when it comes to Moody's and Fitch. So the next case is of Zambia, which is one of the first African country to go through a default process, debt default process, and that was done during the COVID era. So you could see the external shocks taking predominance here. And the credit rating agencies issued or downgraded it to restricted default or selective default, which was in terms of how much the country can actually pay or would be able to restructure in terms of debt. And then it was treated, they treated restructuring as insolvency, which actually prolonged the capital market exclusion. So we could really see the pro-cyclical amplifications there. The borrowing cost increased sharply, the market access collapsed, and the debt servicing burden also rose significantly. So the biasness could be seen in terms of this restructuring process, which was considered to be as credit negative and as a sign of insolvency rather than as a tool for restoring sustainability. In the short-term response, there was a shutout of capital markets. The transmission mechanism channel showed a minimal rating improvement, but it only came out after the IMF program and the pro-cyclical bias that continued with it. So you could really see in case of Zambia, the increased interest repayments and debt service obligations, with interest payments actually rising from 3.5% to 6% of the GDP, with having restricted access to new external funding in terms of financing for different social expenditures. And in case of Zambia, what could really be highlighted is the penalization of the crisis resolution efforts that discouraged the timely restructuring. The next case, which we could see, is in case of Sri Lanka. Can it be showed on the slide? Yeah, thank you. And here the driver classification is debt distress and restructuring, but alongside the political shock, because the debt restructuring really happened during the time of the Rajapaksa regime, and which followed a mass uprising of the people's struggle in 2022. And there was a downgrade that happened from starting from Fitch ratings to category C and then restricted default. And that had a dwindling impact on the foreign exchange reserves, the governance issues, therefore, as a result of the external shocks that were taken in. So the ratings reflected precarious conditions, but also reinforced austerity policies that were aligned with the IMF support. This came in terms of the IMF Extended Fund Facility, which reinforced priorities that would actually leverage fiscal consolidation, something that Bhumika mentioned in her presentation, and the credit repayment over actually taking into account the developmental and social expenditure. So there were principal haircuts, 27%, there were maturity extensions, and some of the coupon rates were also reduced. But at the same time, the restructuring ratings improved only after the fiscal austerity measures were implemented. So we're talking about the significant government expenditure cuts of 44%. And this was in the critical sectors of infrastructure, health, education, and climate. And the public investment was only attributed to 13% of the total spending. So what we can see here is really an impact of how this led to this pro-cyclicality bias, but as a self-reinforcing process coming from the austerity policies. The next case is of Pakistan, which is an important case because it's not only highlighting the climate vulnerability, but it's also a highly debt-distressed country, having the climate vulnerability index of 0.5, which shows that it's like one of the top 10 countries which is climate vulnerable. And therefore, the main event that led to the downgrading impact, that led to the downgrading event was the 2022 climate, the floods, the torrential rains and the floods that followed it, which impacted the country, and in the sense that it affected 33 million people, displaced millions, 1.16 million livestock was affected, and it had a huge impact of $15.2 billion in GDP loss and contributing to 35% of inflation. So the country had already been on the road to the 24th IMF loan, and now currently, as we are speaking, it's on the 25th IMF loan. But this had been part of the incorporation in the credit rating downgrading. And when the credit rating downgrading took place, all of these things were already in place. So the structural inequalities were already there. The IMF bailout program was still in the process. The tranche that Pakistan was supposed to receive only came after in response to the downgrading by the Fitch ratings and the Moody's, which basically was in response to the IMF structural program loan that the country took and the conditionalities that were attached to it. So the fuel price adjustments that included the fuel price cuts, the exchange rate policy amendment, extremely tight monetary policy, which was that there were extremely high interest rates, especially during the adjustment of the phase post floods, that had an impact on the social expenditure that of the country. And there was, again, a heavily dwindling down effect on the social expenditure, especially when it comes to creating space for the disaster relief. So here again, the pro-cyclical amplification came through the downgrading impact during this liquidity crisis, and it reinforced the dependence on the IMF disbursements. And you could clearly see here the trade-off between the climate debt trade-off cycle, which also was mentioned before in terms of the impact of the vicious climate cycle attached to the IMF conditionality of fiscal consolidation loans. The last case that we present is of Maldives, which is the small developing island state. And it's one of the countries which had been also in the middle of the climate event and the debt distress. This is only with regards to how the country is perceived as highly climate vulnerable, but also as highly debt distressed. And therefore, the credit rating downgrade was in reflecting worsening external liquidity, foreign exchange reserves and high debt service. So this case could only highlight how climate exposure was weaponized or instrumentalized to justify the credit downgrading. And in response to that, in the short term, they were declining foreign exchange reserves. It amplified external debt also, and it also damaged investor confidence due to the climate risk attached to it. And the transmission mechanism could be seen through the debt to GDP ratio and the perpetuation that came with the austerity measures also deepened the whole climate exposure and the small stress of the developing island state. And that could be seen also in terms of constrained access to the concessional finance for climate adaptation efforts. So all of these, across all of these countries, and I'm going to wrap it up in order to be in the time restriction, the pro-cyclicality here is not just cyclical, but it's also structural and something that we can see across the cases to be persistent. And it amplified exogenous shocks, it deepened the pro-cyclicality, and also increased the borrowing cost at the forge of the critical events that took place in these countries. Thank you so much.
Thank you so much, Maria, for this presentation. I would like to thank all our panel. Deeply thanks to Susan and Patrick for their contributions on key initiatives and proposals on an independent, regional, and multilateral credit rating agency. Huge thanks to Maria and Jorge for this comprehensive research on country cases, and to Bhumika and the Third World Network for embarking together with us, Latinidad, in this timely and crucial initiative. We have received two written questions that were addressed already in the chat, but I would also invite our panelists if they want to briefly address to them. And I would like also to ask for this final round of concluding remarks, I would like to ask Patrick if you can share with us what are these next steps, what comes next, and how from the positions we are as civil society organizations, academia, and other stakeholders, overall citizens in the Global South, what can we do? So I would like to start this final round with concluding remarks and giving the floor first to Patrick. Patrick, we cannot hear you. Probably you are having
Thank you very
some...
much. I think it has
we
been
can hear you
see
now.
how important this. Yes, I'm sorry. I think I have an internet issue. So I was saying that I would like to thank all the speakers for the very eloquent points they raised and for the excellent presentations made. It is important to note that we are certainly at a shifting point when we look at this global issue of credit ratings, and we can see that all the regions are facing the same challenges with regards to the imbalances and the bias, that we see in the methodology and in the way it is conceived. In that perspective, what can the civil society do? The civil society needs to continue to be engaged to support institutions such as the African Union in the efforts that we are deploying. As you rightly said, Patricia, we are fighting on several fronts. You spoke about the work that we are doing in terms of aligning international tax cooperation to make sure that it works for development. We are also working to address the challenges that we see in the international debt landscape. And we are also engaged in revising or reviewing the methodologies of credit rating agencies. And for this, you can see that when you take all those pieces of work together, you can see that it is a complete puzzle that needs to be reworked, that needs to be put in the right on the right track. So for us, we are absolutely committed to continue pushing this work. It is far to be analyzed as a technical issue. It is a developmental issue because when you look at it, they are going to present it as one of the most technical challenge that we can see on our economies, but it is not certainly about that. It is about the lives of people. It is about securing investment for development. We spoke about the gaps and we spoke about the resources that are being lost by all the the developing economies in terms of the adverse credit ratings that they are getting, even in the worst situation that they are facing. How can countries be facing adverse credit ratings when they are hit by, unfortunate situations like the climate shocks? How can that happen? And when we look at the climate shocks, you will see that our countries are certainly not at the center of the shifting dynamics that we see there, because our levels of pollution, and I take the case of Africa, is estimated as at a level that is below 4%. So how can we be facing adverse ratings when we are facing climate shocks that are not due to our levels of industrialization and development? And that is why we are asking those clear questions to make sure that we all work together to build the cohesive society in which we want to live in, and that we want to, to live to our children. We are looking really forward for the civil society to continue engaging firmly in this process to support those institutional reforms that are important to make sure that finance effectively work for development, and that finance doesn't become a punishment for countries that are already constrained by several structural impediments that are impeding their capacities to develop effectively. So that is what we say. And for us, we remain committed at the African Union to support this process forward. As was highlighted, we are at the forefront of these initiatives, and our aim is to make sure that we create an inclusive world, a world that, credit ratings, debt and taxations are aligned to support development effectively. So thank you very much once again for the opportunity. I do hope that we should continue this conversation moving forward. Back to you, Patricia.
Thank you so much, Patrick. And we have participants registered to this webinar from also other UN delegations, from other countries, from other regions. We have also UN agencies that joined us today. And we really are looking forward to contribute to these discussions with contents, but also with this economic, social, and climate justice approach. So thank you so much, Patrick. And I would like now to give the floor to Susan. There were some questions that I don't know if you wanted to briefly address them, but also the creation of a multilateral credit rating agency is a matter of political will. So if this political will happens and we have a multilateral credit rating agency, how countries, especially our countries in the global south, should be prepared to start with this initiative? Thank you, Susan. The floor is yours for your concluding remarks. Your mic is
Yep. The questions that I saw in the box, I did have responded with one question. I responded with a question myself, is that I'm not quite sure what a neutral benchmark means, and so I can't really respond until I have a definition of that. And then the other one was whether how can climate change, particularly shifts in carbon emissions, can be accommodated within a evaluation of debt sustainability or credit risk assessment, and if you can embed the credit risk within the SDGs. The SDGs do have, I think it's with the SDG 13, there is some scope there for having data on carbon emissions. So you could cast the context where the country is, in which a country is functioning. You can capture that context with the SDGs, like carbon emissions. And yeah, I did have a go with creating a long-term credit risk assessment, and so that's still under review. And so I don't really want to have a comment right on that, but I thought, yeah, it's interesting. I think it can be done. It's just you have to think outside the box. And right now, the methodologies of the credit rating agencies are so prevalent, and also very similar with the IMF. So I feel like the two, the IMF and the credit rating agencies, in some ways, are working hand in hand, because the debt sustainability analysis developed by the IMF is going to be a really good cross check for what the credit rating agencies are trying to accomplish. So yeah, so it's possible. You just have to think outside that box, and there's underneath their approach is actually a really interesting vision. It's actually quite a conservative vision about how capitalism functions. And I think that's another thing that has to be addressed is, can we think about, well, first, is capitalism going to be viable going forward in another 10, 15 years? We'll have systems with markets in them, but we're probably going to be looking at the evolution of something different in how we socially provision ourselves. And that's going to be an interesting challenge. And how do you evaluate, credit risk in that kind of context? It's going to be a much more narrow task, I think. And I think right at the heart of the tension of the credit rating agencies, you have this need to attract investment, finance. You need to appease the financial investors, but you also want to have, socially positive results, as reflected in the SDGs. And there's an interesting tension, because what the financial investors are interested in isn't necessarily improving the SDGs, all right? They want to have their capital back, and they want to have a return on that capital. So it's going to be, there's this tension. So yeah, and how do you cast a long-term credit risk assessment method with that kind of tension? And you have to, I think in the long term, you have to be thinking about the context and social reproduction, so that you can actually keep going in the future, so societies can keep going. You just can't have, this sort of relatively short-term orientation to credit risk assessment where it's basically profit-driven. And so that's so there's, the long term, I think, is more socially oriented. More medium, short term is going to be more profit oriented, because you need the financial investors there to help attract financial investors, maybe pension funds, maybe mutual, pension funds, insurance companies, investors who are long term oriented might be interested in more long term credit risk assessment. Yeah, but it has to be embedded in the context of which countries are functioning. That's captured by the SDGs. So credit risk assessment, you need to, I think, embed, have those, credit risk assessment needs to be embedded in the SDGs. And so, yeah, it'll be interesting to see how that develops. It can't just be tack-ons. And this is what the credit rating agencies are doing. And they, and everybody's sort of casting their ideas under the influence of the credit rating agencies. That method is so prevalent. How they describe it is so prevalent that people can't help themselves in discussing their ideas within that context. And it's very much like economics today, where it's mainstream economics still has a very conservative underbelly to it, as you know. And so a lot of the discourse on policy is guided by that. But Keynesian economics, which has a very conservative underbelly to it. But to try to debate it, you have to demonstrate that you understand it, and then then think outside the box or something different. So I think that's what the UN needs to do. The UN is, my understanding, is a champion for more unconventional approaches, for solutions. And I think it's been too timid and in this area. And I think it needs to be more, have more courage in what needs to be done. And it doesn't mean roiling the financial structure. It just means that you need to have space for discussion and dialogue over this particular industry because it is so influential. And yeah, it's what could countries be doing? I've seen, in the discussions that I've had, I've seen central banks present, all right, and they agree with the ideas. I've seen a few treasuries, but mainly central banks are interested in the credit risk assessment because of the implications for capital flows. And yeah, so maybe central banks could have more of a hand or have more influence in helping to push this, but I don't know. It's kind of a stuck point. I know that the ECLAC would love to have as much support as it can get in order to help put this multilateral credit rating agency on the radar of folks. But yeah, but civil society is very influential for helping these discussions, for helping to push where they can within the UN system for exposure of ideas and keep the debate going. So I think that's really quite important. And I've been monitoring the what's happening in Africa, and I'm looking at what's happening, and I see a lot of discussion about the regulation and processes. Right, I see a lot of discussion about this, but specific details about the methodology of credit risk assessment, those have been few and far between. And I was hoping tonight that I might get a little bit more taste of that, because it seems to me if there's something really quite new coming through, that it should have been validated before it's released. Yeah. So, like some of the ideas that I had, I made an effort to validate those ideas before, I put them down and sent them. So to have something that new and innovative, it could be that's being validated on the sly. I'm hoping that it's validated on the sly before it's released. So that's, but I haven't seen it. And so, yeah. I don't know if Patrick wants to speak to that. But if it's something under wraps, then perhaps he can't. But anyway, so that's my, you have me thinking about how could countries actually push for this? And I have to look at the UN structure a little more closely and see where the countries can actually have some sway on the institutions that I've within the or the subdivisions that I've seen within the UN. So yeah, I don't know if anybody has questions. Yeah. Anyway, so I'm sort of babbling a little bit because it's late. I'm a little bit punchy.
No, totally understandable. Thank you
yeah.
so much, Susan, for these comprehensive remarks, but also for giving us for more food for thought for future discussions. And we have two more questions that I believe are aimed basically for Bhumika, regarding one is from John Swart, I think, from what if there is evidence on the fiscal austerity that it is in fact beneficial for creditworthiness. And a last question from Catherine Mifia from Aphrodite regarding that there are arguments that there should be greater efforts to address some shortcomings that constraining African creditworthiness. So how true are such claims as we consider this MCRA or the African CRA? Please, Bhumika.
Yes, thanks. Okay, I'm glad to see Patrick is still here. Maybe you can also answer that. But if I may, in terms of closing remarks, and I will address the questions quickly as well. In terms of closing remarks, I just wanted to really emphasize that the core objective that we have in highlighting and illuminating the role of these credit rating agencies in particular, right? As zooming in on the financial regulatory landscape, is that the ratings have become increasingly central to development finance as well as climate finance. We are seeing that we cannot talk about development finance without addressing the risk premiums that drive up the cost of borrowing, particularly in the current context where ODA is plummeting, is essentially has become relatively a lost cause. We have a really highly jeopardized development finance architecture today, and the needs are growing, right? The SDGs are derailed. We have layers of aggregated exogenous shocks. So in this current juncture, the need to access markets, the need to borrow, is critical. While we do talk about reducing the dependency on external borrowing, the pragmatic reality is that access to credit is critical. And it's not just access to credit, but also, of course, the cost of repayment. We know that much of debt distress is not regarding the debt stock, but the interest rate servicing, the cost of repayment based on the interest rate itself, right? Which we know just in 2024 went up to an average of 10% for developing countries. So this centrality to development climate finance. And secondly, in addressing Pao's question on objectivity, it really, I want to reroute it to the question of accountability, right? The accountability problem of rating agencies is that sovereigns then become accountable to the rating agencies far more than their citizens, and accountability vis-a-vis the fact that the shareholders of the rating agencies are dominated by four of the largest asset managers, also based in the US, and these asset management companies that are located within the shareholder structure, right? It then creates the accountability problem, the accountability perversion, in fact, where the construction of ratings are really oriented toward their interests and their priorities vis-a-vis profit maximization, but also also maintaining the financial architecture within the ambit of international financial subordination, and in particular, the stratification of interest rates between the high yield bond assets and the safe haven bond assets, the high yield bond assets being in the global south, safe haven bond assets in the key financial centers. And in this maintaining the bifurcation of the global bond markets is a key imperative that the CRAs maintain. And the core point of how it affects access to capital markets, is a core to the accountability problem. So it's really the accountability problem, and this exactly what would be addressed by a multilateral credit rating agency that would be mitigated by an African Union credit rating agency on a regional level. On the question of whether there is compelling evidence that fiscal austerity is in fact beneficial for creditworthiness, well, for whom? That's the main question, right? The accountability for whom is fiscal austerity, is the credit positive beneficial for? So the short-term time horizon, the credit positive framework, I think it's clear who that's beneficial for. And in fact, one of the key aspects we try to show in the case studies is how even proposals for public expenditure, we see this in Indonesia as well as many other middle-income countries, when the government may propose public expenditure initiatives for social development, for climate resilience, it is met by almost an immediate warning downgrade. In Indonesia, when the presidential nominee was campaigning and mentioned that he proposed as free meals for school children, Fitch Ratings sent a warning for a downgrade within 48 hours after the proposal stated by Prabowo when he was campaigning for the presidential seat. So these punitive, the sort of politics of penalization happens on an immediate basis. I will leave Catherine's question to Patrick, who will be far able to answer it. But I hope that our session today helped to illuminate the centrality of rating agencies to development and climate finance, and the ways we can take it forward, the propositional ways forward. Thank you so much.
Thank you. Thank you so much, Bhumika. As we don't have specific questions on the 11 country cases, and we want to create expectation to receive our final reports on this very comprehensive research, I will not put on the spot to Maria and Jorge now. But if Patrick wants to address this specific question, very briefly, and thanks everyone for staying with us for some more minutes.
Yes, Patricia, can you remind me the question very quickly, because I'm struggling to access my my chat.
Sure.
Yeah, I can
Yes,
also
go
read
ahead,
it.
Bhumika.
Yeah, I have it right here. There are arguments that there should be greater efforts to address some shortcomings that constrain African creditworthiness, such as low levels of fiscal transparency, unreliable regulation, large amounts of informal economic activity that remain untaxed, and weak financial sectors. How true are such claims as we consider alternative CRA methodologies and framework institutions?
Thank you very much. I think that's a very important question. And what I can say is that it is part of the perception, the wrong perception that we have those issues can be, true. They are absolutely not at the magnitude that can reverse that can, push for adverse credit ratings. And that is what we have been consistently saying. We have been saying that we have an exaggeration of the ratings and the risk perception on the continent. And you spoke about it, this risk premium that we are paying, which is absolutely not aligned with the fundamentals of our economies. Let me just take one example. Africa is punished to be one of the continents where investing in infrastructure is costing the highest. But when you look at the global data on the risk on infrastructure, as Africa is the less riskier continent in terms of the risks that are perceived in investing in infrastructure, and our return rate even on that is the highest. These are not African Union data. These are data coming from well-known and established institutions. And this highlights the fact that there is this constant misperception of the risk on the continent. The risks are over-evaluated, which are conducting to the situation that we're having today. That single example shows that those institutional bottlenecks that are certainly true in some cases, and that cannot be overestimated the way they are done today, are absolutely not, aligned with the fundamentals of our economies. Because Africa, as of today, is the continent that has the highest potential in terms of investment, and we also have the highest returns in terms of profitability, which means that we have to have that conversation to say there is need for us to absolutely dismantle or review the methodology of credit ratings. They should be aligned with the fundamentals of economies and make sure that they put economies in the right perspective. As I said, I didn't deny that there are challenges here and there. There are challenges. And I want to be lectured about the economies in the world that are not facing such challenges, because those challenges are globally. We can take examples of countries, even in Europe, where corruption and misuse of resources have been highlighted. But have those countries been punished the way we are punished when there is a little case of something that is happening in the sector that is not even truly linked to the potential of our economies? So that is the reality we are pointing out, to say that the reality or the misperception that we have that is sur-evaluating the risk on the continent should be revised, and things need to be put into perspective. I took the example of investing in infrastructure. We can take much more examples to show that there are gaps in terms of the reality and what we are being said to pay in terms of the risk premium that we are paying. So that is what we say, and you can see the consequences on debt. You can see the consequences on various other sectors. We are not mobilizing resources at the pace and levels that are expected to ensure that we sustainably finance our development, which is impeding our ability to attain the SDGs and to move in the right direction. You said something fundamental. ODA is decreasing. Why is ODA decreasing at a time when those countries are in need of concessional financing? It tells us one story, that we need to rely on ourselves, and that is why we have committed to establish the African Credit Rating Agency, that we do believe will certainly not solve all the issues, but will bring another perspectives.
I think we lost you, Patrick. Patrick, can you hear us? I'm afraid we lost Patrick. And well, I want to thank everyone for staying with us, for joining this webinar. Why this is important and crucial: more than 50% of the current external debt portfolio of the Global South countries are owed to private sector through sovereign bonds, and the trends reflect that this could increase in the future years, and all these sovereign bonds are rated by CRAs. This is why it's crucial to have more discussions, more contents on this subject. Thanks to all our panelists, thanks to all the participants for staying with us. And well, we will share with you by mid-April our final report, and we're looking forward to continue with these discussions and contributions from our side, but also to have more exchange with you. Thank you so much, and have a good rest of the day. Thank you, Susan. Have a good night.
Okay, thank you. Yeah, bye-bye.
Thank you, everyone. And thanks, Jorge and Maria and Susan. Thanks for staying up